I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi there! In this video, I'll run Walgreens Boot Alliance through my valuation sheet, ticker symbol WBA, and I will determine if they're finally worth adding to my dividend portfolio. Yes, you heard right, I actually have a dividend portfolio. As I have alluded to several times, I put together a dividend portfolio so I can have another steady stream of income no matter what the macro environment is doing. Basically, that means I'm old.
Excellent.
Or does it? Maybe I'm just being ahead of time.
Oh man, your boy Kevin just lost lots of money. Oh, but that's okay.
Having my growth portfolio, my speculative portfolio, and a dividend portfolio, I would like that extra certainty of getting paid without having to sell any of my great companies. For instance, during a recession, when I'm retired. I wouldn't like that. That's why I have created the dividend portfolio and to show on the channel what is really possible with a dividend portfolio. I'm using a fairly conservative and slowly compounding dividend portfolio, but it's getting along just fine. Now, for this portfolio, I'm now looking at Walgreens, especially as they've been hammered lately.
Hammer time.
Well, lately means over at least the last 5 years, because Walgreens have lost almost 74%. Walgreens Boots Alliance is one of the largest retail pharmacy chains in the United States and now branching out to other countries too. There's around 8,500 locations as of now, and nearly 3/4 of all Americans live within 5 miles of a Walgreens. The company operates in 3 segments: US retail pharmacy, international pharmacy, and US healthcare. Most of the revenue is from the US retail part, but it also has almost $22 billion in revenue from the international sales. Unfortunately, Walgreens is not making a lot of money on their business. Their profit margin is just below 4% when they're doing great, and around 1.33% as a 5-year average. This is a dangerous game, and as we have seen, it doesn't take long before disruptions can kill a business like that. Especially now that Amazon is moving into the field too. Walgreens has been delivering ugly results for years, but in 2023, things have gone from bad to worse. The stock is down by a whopping 43% year to date, and there seems to be no end in sight to this tailspin. This is not a dip. Investors who buy the stock are trying to catch a falling knife. Even in just the past 6 months, shares of the pharmacy chain are down over 33%. The consensus analyst price target for Walgreens is around $27. That would suggest a nice upside compared to where it trades now. But before you pull the trigger based on so-called smart money projections, keep in mind that analysts often adjust their price target as the stock moves. So, basically, they adjust their target to match the sentiment, and they're not really projecting anything. Don't know why they're called smart money, actually. A year ago, the consensus price target was nearly $46. At that time, the stock traded at $37. Well, considering the company's low margins, lower foot traffic in the stores, and that the boost from the 2020 pandemic vaccination has ended, and they have a 9% dividend yield, which some might feel is in jeopardy, it wouldn't be surprising if there's going to come a lot of analyst downgrades soon. Walgreens' decline has been so significant that the stock now trades below book value. It's trading at a price-to-book multiple of 0.94, which is a sure sign of something is wrong. When a stock is trading below its book value, it can be an attractive value proposition to investors. Typically, this can also be a value trap. Walgreens has been below book value for some time, and thus far, that hasn't provided any kind of support for the stock. Now that Rite Aid is going bankrupt, certainly isn't helping. They were hit by lawsuits, and because they have a large debt load, the company is in a bad position. If they can go bankrupt, why should Walgreens be safe? It doesn't mean that Walgreens is in the same situation. but it sure isn't funny when margins are that low and you have a high debt load. The truth is, Walgreens doesn't face a rosy future, particularly considering the competition it faces from Amazon, Walmart, CVS Health, and other companies, but its cash situation isn't as dire as that of Rite Aid. Walgreens' numbers aren't terribly strong, given that they're spending billions on expanding their healthcare business and opening primary care clinics, but at the very least, they're not as risky as Rite Aid. So, how low could Walgreens go? Well, it's trading well below book value, and it's also below the lowest analyst price target of $22. So, given the bearishness right now, it could easily fall below 20. I expect the stock to rebound because there's already so much negativity priced into the stock that it would be hard to imagine the company going even worse. Walgreens management expect to close around 450 to 500 stores in 2024. They need to do that to trim the fat off. But still, growth will be driven by the aging population and the increased use of specialty drugs, and hopefully these store closures will help with profitability. But as I mentioned, Walgreens could be a value trap, and remember, even great stores like Sears, JCPenney, Toys R Us, and Barney's, they all went belly up. So even well-known brands can end up broke. Walgreens' revenue has been steadily rising the last years. However, the margins were low, and the strategy of buying their growth hasn't really paid out yet. And now that the CEO has stepped down, management say they will turn Walgreens around. So, is Walgreens a turnaround play or is it a value trap? Let's see if the data can help us or at least give us an indication of what to do with this. I have put in the last years of economic data into my valuation sheet. I used to get the data from macro trends, but I'm beginning to use the market is open for data. I do this because from the market is open, I can download all the data directly into my spreadsheet, saving me a lot of valuable time. Time is the only thing we can never get back. So, revenue and earnings. As usual, the 5-year outlook can be skewed a bit, but as you can see, Walgreens were on a good path until 2020. That's where margins got killed. They benefited from the boom after 2020, but in 2023, the whole thing fell apart again. So on the revenue and earnings part, the score ends up being a meager 33%. That's not very good, and guidance for 2024 is not much better. Now let's look at financial strength. How is the company handling its cash and its debt? And when we look at the numbers, it becomes fairly obvious that debt is high and cash is low. Remember, the quick, current, and cash ratio all tell us about the company's short-term liquidity and if they're able to pay their liabilities, and it does not look good. When we also look at the Altman C score, which is usually an indicator if a company is going down or up, it tells us that they're just on the brink of distress. Also, weighted average cost of capital versus return on invested capital is telling us if value is being created or destroyed, meaning if return on invested capital is higher than the weighted average cost of capital, the company is creating value. But here, it's the opposite, quite terrible. The WACC is 4.53% and return on invested capital is minus 5.62. Eesh. So the final score in financial strength is a shocking low 8.33%. I don't think I ever saw a score that low. Moving on to profitability and growth. Here we look at how the company is doing on the earnings side and if it's moving in the right direction. To save time, I won't go through every detail here. If you want to hear how every part is calculated and what the individual items mean, please see my explanation video where I go through all the metrics in depth. I have left a link in the comments for that. Margins have been low for some time, and 2023 is really bad. And because the growth is measured on a 5-year basis, they don't look good. Again, the total score is 8.33%, which is horrible. Dividends, finally a positive part. Walgreens being a dividend aristocrat and on the path of becoming a dividend king. This part actually looks good. The payout ratio is a problem in the calculation, as earnings for 2023 is negative. But if we use last year's numbers, we would have had about 48% payout ratio. But I'm sorry, we need to live in reality, so the score must remain. The hope could be that the attractive dividend and the fact that Walgreens is a dividend aristocrat could get investors to pile in, boosting the stock price. However, that does not help the fundamental business and will only be a short-term gain. So, the real important question we need to ask here is what will happen next? Is Walgreens experiencing the same drops as in 2020 and will rise again to 2022 levels? Maybe. There are arguments for both the positive outcome and a negative outcome. I would argue the positive outcome is more plausible. The shrinkage and looting will not last. No society will accept this behavior for a long time, even though it seems California does it, so I don't know. But trust me, eventually the people will vote, either with their feet or with their money. When you're a dividend aristocrat with 46 consecutive years of raising dividends, you will think twice before lowering dividends. And that could very well be part of the problem. But again, they could soon become a dividend king, which is a very attractive group to be a part of. Most dividend investors would really like that title and invest in those companies no matter what. So yeah, I think Walgreens will be okay in a couple of years, and if you're a gambling man or woman, then this could be a good turnaround play. Just not for me.
You could ask yourself a question. Do I feel lucky? Well, do you, punk?
I will only gamble in my speculative portfolio, and this is a gamble for me. Remember, I need to see at least 75 or 80% as the final result, or else I won't invest. And even if I would invest, I would like to see the stock below $20 before I start a position. That would be lower than in 1998, and that's saying something. Just to show you I'm not pulling share prices out of my... I will take a quick tour of my valuation part. And I also looked at a couple of other valuations just to check if I'm in the money or way off. For instance, Guru Focus valuation, which I actually find way off and weird, especially as their own DCF valuation hits around the same stock price I get, and I believe that's around the correct price. The first part of my value metrics are not looking good, and the complete score is only 50%. But let's look at what the share price should be. Book value per share is around $23. My EPS valuation ends up with almost $24. Here I assume a growth rate of 6 to 6.5% growth rate over the next 10 years. So even with a couple of bad years, that should be possible. My discounted cash flow valuation using the same growth rate gives us around $20.39. My modified version of the Graham number is around $28. And the modified Peter Lynch fair value can't really be calculated, so I have to set it at 20. The median of all these prices is $23, and with a 10% margin of safety, I have a buy price at around $20.76 per share. We need to remember that my EPS and cash flow valuations are based on last year's $5 earnings per share, but I have also used a small growth rate, so these would balance out in over time, I think. As I mentioned, Walgreens Boot Alliance is not for me in my dividend portfolio at least. I believe there are more interesting companies which are a lot more secure. Remember, dividends are supposed to last for a long time. But maybe I could actually use a small position in my speculative portfolio. I mean, if or when it goes below 20, I bet there will be a lot of dividend investors who will fall into this possible value trap and giving me a 15 to 20% upside.
Babe, how much did we make today?
$5 million?
How much did we lose today?
$1 billion.
And yesterday?
$4 million?
And yesterday?
$1 billion.
What do you think? Let me know in the comments. Oh, and please help me grow this channel by hitting the like button. Thanks. On that note, I will end the video. I hope to see you in the next one. And remember, invest in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting.